There was a guy in 1770 who figured out he could print money, and nobody stopped him until he destroyed an entire country's economy. His name was John Law, and he convinced France to let him run their national bank. Within 2 years, he had created so much fake wealth that people were literally trampling each other in the streets to buy shares in a company that owned nothing but swampland in Louisiana. Then it all collapsed, and France didn't recover for decades. I'm telling you this because the same pattern is happening right now, except this time, it's not one guy in a powdered wig. It's your retirement account. My name is Tom, and I spend way too much time thinking about how most people are sleepwalking into financial disasters they could easily avoid. If you're someone who feels like traditional investing advice sounds great in theory, but never seems to work when you actually need it to, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact concentration mechanism that every major brokerage uses to funnel your money into the same 7 companies, and why that's setting you up for a crash that could wipe out 20 years of savings in 18 months. I'm gonna show you what I'd actually do if I were starting from scratch in 2026. Knowing what I know now about how markets really work versus how they're sold to you. So let's go back to John Law in 1720. Here's what happened. France was broke after too many wars, and they had this massive debt problem. John Law shows up and says, hey, I've got a solution. Let me start a bank that issues paper money backed by future profits from French territories in America. The French government, desperate for cash, agrees. Law creates the Mississippi Company, which supposedly owns all this valuable land in Louisiana. He starts issuing shares. People buy them because paper money is easier than gold, and everyone's getting rich on paper. The share price goes from 500 livres to 18,000 livres in less than 2 years. Everyone in Paris is selling their property, their jewelry, everything to buy more shares. They're camping outside Law's house, trying to get in on the next offering. But here's the catch. The Louisiana territory was basically worthless swampland. There was no gold, no profitable trade, nothing generating actual revenue. Law was just printing money and using new investments to pay returns to earlier investors. Classic scheme, right? But it gets worse. Law knew it was unsustainable, so he started printing even more money to buy up the debt himself, inflating the currency while inflating the stock. The French government loved it because their debt was disappearing, so they gave him more power. Then in 1720, people started asking questions. They wanted to convert their paper shares back to gold. Law didn't have the gold. The bank couldn't honor the conversions. Within 6 months, the shares crashed from 18,000 livres to 500, then to 0. People who had been millionaires on paper were bankrupt. The French economy collapsed so hard that they banned paper money for decades. Law fled the country and died broke in Venice 9 years later. Here's who won. The French government had unloaded a ton of debt onto private investors who were left holding worthless paper. A handful of insiders who got out early walked away wealthy. Here's who lost. Basically everyone else in France. Middle-class families, small business owners, people who believed the system would protect them. And here's the kicker. The bankers and government officials who enabled Law faced almost 0 consequences. They just moved on to the next scheme. So what does this have to do with investing in 2026? Everything. Because right now, you're being sold the same concentrated bet, except instead of Louisiana swampland, it's 7 tech companies. Imagine you're building a house, and the contractor says, we're gonna use the best materials. Sounds great, right? Then you find out that 70% of your entire house, the foundation, the walls, the roof, all of it is supported by 7 wooden beams. Those beams are really strong right now, strongest beams on the market. But you're thinking, what happens if 3 of those beams crack? The contractor says, don't worry. These beams have been getting stronger every year for 15 years. Would you live in that house? Would you raise your kids there? Because that's exactly what your index fund is. As of early 2026, the S&P 500 index, the thing every financial advisor tells you to buy and hold forever, has more than 30% of its total value concentrated in 7 companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, 7 companies out of 500. That's 1.4% of the companies, holding nearly a third of the weight. Back in the 90s, the top 7 companies made up maybe 15%. We've doubled the concentration in 25 years, and everyone's acting like this is normal. Now, you might be thinking, okay, but those companies are massive and profitable. They print money. That's true, but so did the Nifty 50. Let me tell you about the Nifty 50 in the early 70s. These were the 50 stocks that every institutional investor said you could buy and never sell. Blue chip American companies like Polaroid, Xerox, Kodak, Avon, Sears. The idea was that these companies were so dominant, so well managed, so essential to American life that you didn't even need to look at the price. Just buy and hold forever. Growth was guaranteed. These stocks were trading at price to earnings ratios of 50, 60, even 80 times earnings, which is insane. But people said it didn't matter because growth would catch up. Then 1973 happened. Oil crisis. Inflation spiked. Recession hit. Suddenly growth stocks weren't growing. The Nifty 50 crashed. Polaroid fell 91% from peak to trough. Avon fell 86%. Xerox fell 71%. These weren't speculative startups. These were the safest companies in America. And if you bought at the peak in 1972, it took you 25 years just to break even on some of them, not counting inflation. A quarter century of zero returns on the safest investments. Here's what happened step by step. First, institutional investors decided that a small group of stocks were so good that valuation didn't matter. Second, they poured money into those stocks, driving prices higher and higher. Third, the high prices became evidence of quality, creating a feedback loop. Fourth, when economic conditions changed, those overvalued stocks had the furthest to fall. And fifth, the diversification everyone thought they had disappeared because all the safe stocks crashed together. But here's the part nobody talks about. Who made money? The executives at those companies who sold stock at the peak. The investment banks who underwrote the offerings and collected fees. The early investors who got in at reasonable prices and got out before the crash. Who lost? Regular people who bought at the top because their financial advisors said it was safe. Pension funds that needed steady returns. Retirees who thought they were being conservative. And the most surprising twist, the financial industry learned nothing. They just waited 20 years and did it again. With tech stocks in the late 90s, then again with housing in 2007, and now again with mega cap tech in 2026. So what does this pattern look like today? Let's talk about NVIDIA. Incredible company, genuinely revolutionary technology. I'm not saying they're bad. But in 2023, NVIDIA was worth around $300 billion. By early 2026, they crossed $3 trillion. That's a 10 times increase in under 3 years. Their revenue grew, sure, but not 10 times. What grew 10 times was the multiple investors were willing to pay. The same thing that happened with Polaroid in '72. Now you're asking yourself, is NVIDIA overvalued? Maybe, maybe not. That's not even the point. The point is that your index fund is now massively dependent on NVIDIA staying at that valuation or going higher. If NVIDIA drops 50%, which is not some crazy scenario given it's happened to every high-flying tech stock eventually, that alone takes almost 5% off the S&P 500. Add in similar drops for Apple, Microsoft, and a couple others, and you're down 20 to 30%, even if the other 493 companies do fine. This is where it gets really interesting. The system is designed to hide this risk from you. Here's how. First, they call it diversification. You own an index fund with 500 companies. That sounds diversified. But if 7 of those companies are a third of your money, you're not diversified. You're concentrated. It's a linguistic trick. Second, they use market cap weighting. Sounds technical and smart, right? All it means is that the stocks that have already gone up the most get the biggest share of new money. You're automatically buying more of what's expensive and less of what's cheap. It's the opposite of what every successful investor actually does. Third, They show you long-term charts that smooth out the crashes. Yeah, the market always recovers eventually, but eventually might be 25 years, and you might not have 25 years. Let me give you the emotional reframe you need. You are not a passenger in this system. You are the product. The financial industry makes money from fees and volume, not from your returns. When they say buy and hold index funds, what they mean is give us your money and don't ask questions for 30 years while we collect our percentage regardless of what happens. I'm not saying index funds are evil. I'm saying blind index investing in 2026 is playing a game where the rules are rigged against you. So if I were starting fresh right now, knowing what I know, here's exactly what I'd do. Not what sounds good in theory, not what worked in 2010, but what actually makes sense given the current concentration risk and market structure. Action step 1. I check my actual exposure right now. Not what I think I'm exposed to, what I'm actually exposed to. If you own an S&P 500 index fund or a total market fund, go look up the top 10 holdings. Add up the percentages. If it's more than 25% in the top 10, you're concentrated, not diversified. Most people have never done this. They just assume index fund equals safe. Go look tonight. Vanguard, Fidelity, Schwab, whoever you use, they publish the holdings. 5 minutes, do it. Action step 2, I'd implement what I call the inverse concentration strategy. Here's how it works. Instead of letting market cap weighting automatically put 30% of my money into 7 stocks, I'd manually create a position that does the opposite. You can buy equal weight index funds where all 500 companies get the same allocation regardless of size. Or you can buy international developed markets, which are trading at 15-year low valuations compared to US stocks. Or you can buy small and mid-cap value stocks, which have historically outperformed large-cap growth over 20-year periods, but have been left behind for the last decade. I'm not saying sell everything and go all in on small caps. I'm saying if the market is automatically concentrating your risk in 7 companies, you need to manually rebalance that risk somewhere else. If 30% of a standard index is in mega cap tech, maybe 30% of your portfolio goes into things that are negatively correlated or at least uncorrelated. Emerging markets, commodities, real estate investment trusts that actually own physical property, treasury inflation protected securities if you're worried about inflation coming back. Here's the math on why this matters. Let's say you have $500,000 in a standard S&P 500 fund. About $150,000 of that is in the big 7 tech stocks. If those stocks drop 50% over the next 2 years, which happened to the Nifty 50 and happened to tech stocks in 2000 to 2002, you just lost $75,000 from that concentration alone. The other $350,000 might stay flat or drop less, but you're still down 15% overall, just from 7 stocks. Now imagine you had rebalanced 6 months ago. You moved 75,000 of that 150,000 into equal weight or international or small cap value. Those alternatives might also drop, but they won't drop 50% because they're not as overvalued. Maybe they drop 20%. Now you've lost 15,000 instead of 75,000. That's $60,000 of protection just from recognizing the concentration risk. But now you might be thinking, what if those 7 stocks keep going up? What if Nvidia hits 5 trillion and I miss out? Here's the thing. You have to decide what you're optimizing for. Are you trying to maximize your upside if the current trend continues forever? Or are you trying to build actual wealth that survives different market conditions? Because nobody, and I mean nobody, can tell you when the music stops. John Law's Mississippi Company looked like a sure thing until it didn't. The Nifty 50 looked unstoppable until they stopped. Housing prices only go up until they go down. I'd rather make 70% of the gains in a bull market and avoid 70% of the losses in a bear market than swing for the fences and risk losing everything. That's not being scared, that's being smart. The people who got rich and stayed rich are the ones who didn't blow up. Action step 3, I'd set up what I call valuation tripwires. These are automatic rules that force me to rebalance when things get crazy. Because in the moment, you won't want to. In 1999, people who sold tech stocks looked stupid for 2 years. Then they looked like geniuses. You need rules that remove emotion. Here's an example rule. If any single stock in my portfolio becomes more than 8% of my total account value, I automatically sell enough to bring it back to 8%. If the S&P 500 price to earnings ratio goes above 30, I automatically move 10% of my stock allocation into bonds or cash. If the top 10 holdings in my index fund exceed 30% of the total, I rebalance into equal weight. These aren't market timing, these are valuation discipline. You're not trying to predict crashes, you're limiting your exposure to expensive assets and rebalancing into cheaper ones. This is what every successful endowment and sovereign wealth fund does, but retail investors are told to just buy and never sell. Action step 4, and this is the one nobody talks about. I'd build an income floor outside the market. This is psychological as much as financial. The reason people panic sell at the bottom is because they need the money and the market is crashing and they have no other option. If you have 12 months of expenses in a high yield savings account earning 4 to 5%, and you have some dividend paying stocks or bonds throwing off even a small amount of income, you can survive a market crash without selling at the bottom. You can wait it out. You can even buy more when things are cheap. Here's the math. If you spend $60,000 a year, you need $60,000 in accessible cash or equivalents. Yeah, that's money that's not compounding in the market, but it's insurance that lets you stay in the market when everyone else is forced out. During 2008, people with cash bought stocks at 50% off. People without cash sold at 50% off to pay their mortgage. Same event, opposite outcomes, entirely based on having a buffer. I'd also look hard at building income streams that aren't tied to my portfolio value. This could be a side business, rental income from real estate, royalties from something you create, even a part-time consulting gig in your field. The goal is that if the market cuts your portfolio in half, your life doesn't fall apart. You're not desperate. Desperation makes you sell low and buy high, which is how wealth gets transferred from regular people to institutions. Action step 5. I'd get really honest about time horizon. The advice to buy and hold for 30 years is great if you're 25. If you're 45 and planning to retire at 60, you don't have 30 years to recover from a crash. You have 15 years. And if a major crash happens in year 10, you're screwed. The sequence of returns matters as much as the average return. 2 people can get the same average annual return over 20 years. But if one person has a crash right before retirement and the other has it early in their career, the first person runs out of money and the second person is fine. If you're within 10 years of needing the money, whether that's retirement or buying a house or funding a kid's college, you cannot afford to have 30% of your portfolio in 7 stocks that are priced for perfection. You need to de-risk even if it means lower returns. Because losing 25% when you're 55 is not the same as losing 25% when you're 30. At 30, you have time and income to recover. At 55, that loss might be permanent. So here's the bigger picture. The financial industry has spent 40 years convincing you that investing is complicated and you need experts, and then the experts tell you to buy index funds and do nothing, which is the least complicated strategy possible. Why? Because it's profitable for them and easy to scale. They're not wrong that index funds are better than picking individual stocks for most people, but they're lying by omission when they act like all index funds are the same and concentration risk doesn't exist. Just like John Law convinced France that paper money backed by nothing was the same as gold, the financial industry has convinced you that an index fund with 30% in 7 stocks is the same as diversification. It's not. It's a concentrated bet on the continued dominance of a handful of companies that are trading at valuations that have historically preceded major crashes. Now, am I saying those 7 companies are going to crash tomorrow? No, I have no idea, and neither does anyone else. Microsoft might be worth 10 trillion in 5 years, or it might be worth 1 trillion. What I'm saying is that if you're not aware of the concentration, if you're not actively managing that risk, you're making the same mistake that people made with the Mississippi Company and the Nifty 50 and .com stocks and housing. You're assuming that what's worked recently will work forever, and you're ignoring the structure of the bet you're actually making. Let me tell you what the smart money is doing. And by smart money, I don't mean hedge funds doing crazy derivatives. I mean endowments and foundations that need to generate returns for decades without blowing up. Yale's endowment, often considered one of the best managed pools of money in the world, has less than 10% in US stocks. 10%. The rest is in private equity, real assets, foreign markets, absolute return strategies, things that don't move in lockstep with the S&P 500. They're not trying to beat the index every single year. They're trying to compound wealth across different economic environments without catastrophic losses. You can't replicate Yale's endowment as a regular person. You don't have access to the same investments, but you can replicate the philosophy. Diversify across asset classes that don't all crash together. Don't let any single bet, whether it's a company or a sector or a country, become too big. Rebalance from expensive to cheap. Build income sources outside your portfolio. Boring, I know, but boring is what survives. Here's what I'd avoid in 2026. I'd avoid anything that's sold as you can't lose or guaranteed returns or safe as the market. If it sounds too good to be true, it is. I'd avoid trying to time the market by going to cash and waiting for a crash because you'll miss years of gains and probably get back in at the wrong time anyway. I'd avoid complex products I don't understand, leveraged ETFs, inverse funds, option strategies sold by gurus on YouTube. If you can't explain how it makes money to a 12-year-old, don't put your savings in it. And I'd avoid the temptation to do nothing just because doing something feels overwhelming. Doing nothing right now, when concentration is at historic highs, is an active choice to accept that risk. It's not neutral. You're not being patient, you're being passive, and there's a difference. Let's talk about the psychological shift that needs to happen. Most people treat their portfolio like a plant. Water it with regular contributions, leave it in the sun, check on it once a year, hope it grows. That worked great. From 1980 to 2000 and from 2009 to 2021, when we had multi-decade tailwinds of falling interest rates and expanding valuations. But those tailwinds are over. Interest rates are higher and unlikely to go back to zero. Valuations are already at the top end of historical ranges. You can't just plant your money and forget it anymore. You have to treat your portfolio like a garden. You still plant and water, but you also weed, you prune, you rotate crops, you adapt to the seasons. That doesn't mean daily trading or obsessing over every headline. It means quarterly check-ins, where you look at valuation, rebalance what's gotten too big, trim what's expensive, add to what's cheap. It's active management in the sense of being engaged, not active trading in the sense of constant buying and selling. The reason this matters emotionally is that when the next crash comes, and it will come because crashes always come, you need to know that you did something. If you just bought a standard index fund and hoped, you're gonna feel like a victim when it drops 30 or 40%. You'll panic, you'll sell at the bottom, you'll swear off stocks forever. But if you've already taken steps to reduce concentration, to build an income floor, to diversify across assets, you'll feel like you prepared. You won't be happy about the losses, but you won't be destroyed. You'll be able to hold on or even buy more, and that's the difference between people who build wealth through cycles and people who get wrecked. Here's a scenario to make it concrete. It's late 2027. There's been some kind of shock. Doesn't matter what, recession, geopolitical crisis, tech regulation, whatever. The mega cap tech stocks drop 40% in 6 months. The S&P 500 drops 28% overall. Your coworker who has everything in a standard index fund and needed to retire in 2028 now has to work 3 more years because his portfolio went from $900,000 to $650,000. He's angry. He's scared. He sells half of what's left and puts it in cash, locking in the losses. The market recovers over the next 3 years, but he missed most of it because he was in cash. You, on the other hand, rebalanced a year earlier. You moved some money into equal weight, some into international, some into bonds. You kept a cash buffer. Your portfolio drops 20% instead of 28%. Not fun, but you knew it could happen. You don't need the money for 5 more years, and you have a year of expenses in cash, so you don't have to sell. Actually, you take some of that cash and buy stocks at lower prices. 3 years later, when things recover, your portfolio is higher than it was before the crash. Same market, different outcome, because you prepared. That's what I mean by taking control. You can't control what the market does, but you can control your exposure, your liquidity, your emotional resilience. Most people give up all three because they're told that investing is either too complicated for them or so simple that they shouldn't think about it. Both are lies designed to keep you passive. Let me give you one more historical example to drive this home. In 1989, Japan's stock market was the largest in the world. The Nikkei index hit 38,915. Japanese companies were buying up American real estate. Everyone said Japan would overtake the US economically, and Japanese stocks traded at 60 times earnings because growth was inevitable. If you were a Japanese investor in 1989 and you listened to the experts who said, just buy the index and hold, you would have lost 75% over the next 3 years. The Nikkei bottomed around 7,000 in 2003. As of 2026, 37 years later, it only recently got back to the 1989 peak. 37 years of zero real returns. Now, Japan had specific structural problems, demographics, debt, zombified banks. But the point is that the market always comes back is only true if you're talking about the global market over a century. Specific markets can stay down for decades. And even in the US, which has been the best performing market in the world, there have been stretches where stocks went nowhere. 1966 to 1982, basically flat after inflation. 2000 to 2012, flat. If you retired at the wrong time, you were in trouble. So the lesson is not don't invest in stocks. It's don't assume that what worked for the last 15 years will work for the next 15. The US market has been the best performing in the world. Megacap tech has been the best performing sector. Passive indexing has been the best performing strategy. All of those could reverse. And if they do, the people who were 100% in a cap-weighted US index fund will suffer the most. What would I actually buy in 2026 if I were building a portfolio from scratch? Here's the mix I'd start with. And I want to be clear, this is not financial advice. This is what I do for myself, knowing my risk tolerance and time horizon. 30% in a diversified US stock fund that's equal weight or tilted towards small and mid-cap value. 20% in international developed markets, Europe, Japan, Australia, places that are cheaper than the US right now. 10% in emerging markets for long-term growth exposure. 15% in real assets. This could be REITs, commodities, infrastructure funds, things that do well when inflation picks up. 15% in bonds, a mix of treasuries for safety and corporate bonds for yield. 10% in cash or short-term equivalents, your emergency fund and opportunity fund. That's 100%. And notice that none of it is in a standard cap-weighted S&P 500 fund. I'm not opposed to those funds, but in 2026, given the concentration risk, I'd rather build diversification manually. This mix gives you exposure to stocks for growth, international for diversification, real assets for inflation protection, bonds for stability, and cash for flexibility. No single position dominates. If tech crashes, you're not destroyed. If inflation spikes, you have some protection. If interest rates rise, your bonds might suffer, but your cash can be redeployed. You're not trying to predict the future, you're trying to survive different versions of it. Would this portfolio beat the S&P 500 if the current concentration trend continues and those 7 stocks double again? No, it wouldn't. You'd underperform, and that's okay. Because if the concentration reverses and those 7 stocks crash, you'd outperform by a huge margin. You're trading maximum upside for lower downside. And at a certain point in your wealth building journey, that's the right trade. When you're trying to get your first $100,000, sure, take more risk. When you're trying to protect 500,000 or a million, not losing it becomes more important than doubling it. Here's the final psychological shift. Wealth is not built by hitting home runs. It's built by not striking out. If you can generate decent returns, 7 to 9% a year, and avoid catastrophic losses, you'll end up in the top 10% of investors over 30 years. The people who chase 15% returns are the same people who blow up when they hit a bad stretch. Slow and steady actually wins, but only if you're steady through the rough patches, and you can only be steady if you've prepared. So if I wanted to invest in 2026, I'd start by admitting that the environment is different than it was in 2010 or even 2020. Valuations are high, concentration is extreme. The easy gains from falling rates are over. I'd check my actual exposure and fix any concentration risk. I'd build a cash buffer so I'm never forced to sell at the bottom. I'd diversify across assets and geographies, not just companies. I'd set up rules to rebalance automatically so I don't have to rely on willpower. And I'd accept that I might underperform in the short run if the current trends continue, but I'd sleep better knowing I'm not betting everything on 7 companies staying expensive forever. That's it. Not complicated, not sexy, not gonna make me a millionaire in 12 months. But it's real. It's based on how markets actually work, and it's designed to survive different outcomes instead of relying on one specific thing to keep happening. Most people won't do this because it requires effort and it means admitting that the default option might not be the best option. But if you're still watching, you're not most people. You're someone who actually wants to understand this stuff and make smart decisions, not just follow the crowd off a cliff. So go check your portfolio tonight, look at the concentration,